With stock buybacks, investors have a choice on whether to sell stock, yet investors don't have a choice on whether they receive a dividend. Hence, it can be argued that stock buybacks are a more efficient way for shareholders to decide how to allocate resources. Yet some may argue that since companies engaging in buybacks signals to shareholders that they don't have productive investments to throw money at, that excess cash can instead be distributed to government services like schools and healthcare via the stock buyback tax. But a tax on buybacks could instead encourage companies to hoard their money, which companies did pre-2017. And here we see the managerial agency problem, commonly pondered in finance. A firm with excess cash reserves may be associated with lower firm value because self-interested managers can instead misuse those funds to benefit themselves instead at the expense of the company. Stock buybacks would be a way to avoid that problem. Furthermore, instead of the tax encouraging investment, dividends could instead be favoured. This is quite important, as Biden is considering raising the excise buyback tax to 4%. If the excise tax is raised, it could increase dividends at the expense of buybacks, where dividend tax revenue rises, while excise and capital gains tax revenues for buybacks fall. In fact, a study by James Porterbar analysed the 2003 American Act that cut dividend and capital gains taxes and predicted that the tax reform would increase dividends by 20%. Using this study, the Tax Policy Center estimated that a 1% rise in a tax on stock buybacks will increase dividends by 1.5%. Encouraging more dividends may be more beneficial for investors, especially since a higher dividend yield is more correlated with S&P 500's return than a higher buyback yield. For instance, dividend yield explains 54.9% of the S&P 500's return over 5 years, while buyback yields only explain 10.2%. Not to mention that dividends are harder to manipulate than share buybacks, but require a longer term commitment from corporations as well, since dividend payments are permanent. Speaking of dividends and taxation, a common complaint in the stock buyback debate is that dividends and stock buybacks are treated differently in terms of taxes, yet are both ways of returning money back to shareholders. Dividends have been taxed for a long time, but the buyback tax just happened this year. Critics aim to close this so-called tax differential between stock buybacks and dividends. When it comes to looking at the tax disparity with dividends, the 1% stock buyback tax is eclipsed by the top rate of 23.8%. Since capital gains taxes are more relevant to buybacks, we'll use this. Capital gains are taxed on average 2.1%, while dividends are taxed on average 12%, so the tax disparity is roughly 10%, assuming no foreign taxes on dividends or capital gains. The 1% buyback tax should reduce the differential by 10%, so has a predictably pretty small effect. If we are aiming to eliminate the tax differential entirely, then Penn Wharton created a model where they modified the tax rate on buybacks with a lower bound estimate requiring 1.6% to eliminate the tax differential between buybacks and dividends, a baseline estimate requiring 4.6% to eliminate the tax differential, and an upper bound estimate requiring 9.6% to eliminate the tax differential.